So thank you, Joe, for inviting us to the meeting today to do a presentation. Appreciate that. And as most of you are probably aware, I was the VP of Business Development at Hercules. And I left about this time last year. And since then, I founded Verde Capital Advisors and the Verde Life Fund because I wanted to give clients a more secure and consistent investment option. And I'm sure we can all appreciate that after what we lived through in the last couple of years. And here's my brief bio, just so you know a little bit about me. I have an economics degree from the University of Wisconsin. My corporate experience includes sales and marketing from IBM and Thomson Reuters. And my finance background includes life insurance and alternative investments, where I started working with my business partner, Jordan Trice. And now I'm going to turn it over to Jordan because he'll be doing the overview of the Verde Life Fund.
Hey everybody, well, welcome. Just switching some stuff up here. Give me 1 second. So I have been in finance for really my entire adult life. Can you guys still see me?
There we go.
How's that? I've been in finance for my entire adult life. So I have been able to work many different fields in finance. Kind of at the early times, it was very much a quest to find the thing that really spoke to me the most. I mean, I did retail banking, investment banking. I did a lot of financial education, mortgage banking. If anybody remembers 2007, 2008, that was when I was actually doing great in mortgages. And then, of course, the bottom fell out. If anybody remembers AmeriQuest, that was one heck of a ride, up and down. And about 5 years ago, I got hired by a private equity firm that I had been kind of pursuing. And it was really a match made in heaven because I got to work with institutional investors and registered investment advisors and these other very sophisticated investment group. And I said, why would anybody want to be a stockbroker trying to sell the latest meme stock to a guy with a $13,000 account when I could talk to people who really understand how high finance works? And being there, it just taught me so much. And I got this beautiful network of people. That's originally where Eric and I met. And then I finally said, you know, it's time that I go out and build a better mousetrap, essentially. And so that's when we went out and we met some great capital people in the life settlement space. And we said, this is amazing. Let's build a product around this opportunity, this network access. And that's how we came up with Verde Capital Advisors and where we are today.
Great.
So if we want to just jump right into it, what I'd like to do is just talk a little bit before I start changing the screen around about what makes a life settlement and why the life settlement space is very investable. So a long time ago, we're talking like 1913, the Supreme Court said, it is okay for you to buy and sell your life insurance, just like you would a house or a car or anything else. And so that spawned this whole opportunity for 6 seniors, we call them health impaired seniors, to sell their life insurance policies. And there really wasn't a market for it. They just said, hey, you can now sell your life insurance. And that was great. It really wasn't until about 50 or 60 years ago that the really large institutional investors started to get into this. So you see people that have hundreds of billions of dollars of assets under management or control, or these wealth advisors that say, this is a great place for us to be in. And I'll tell you why here in a minute. You have the Warren Buffetts of the world, you've got family offices, pension funds, and they're all kind of playing in this space. And we all hear the whole adage of the rich get richer. And one of the reasons that's true is because they just have access to certain investments that most investors don't have access to. And a while ago, we realized that, hey, these large investors are always going to play in this space. But what we can do is we can give people access to the same space that are kind of in that $1 to $10 million range and above. Of course, we have some institutionals that we work with, but it gives them a chance to say, we want to be a part of this space, just like these really big guys. So those lower level accredited investors. And that's really where this came from. So if you look at the space as a whole, whether that's us or our competitors, et cetera, the space does incredibly well from a couple of different angles. Number one, it's very low volatility. I mean, the worst thing to ever happen to the mortality space was when they changed some of the actuarial tables that a lot of the life expectancy companies use. And a lot of funds took a few percentage point hit that month and still ended the year positive. I mean, that's literally the worst thing to happen in the industry. And if I had said the same thing about bonds or stocks, you know, we'd all think about 2007, 2008, or maybe even March of 2020. And we know how crazy volatile that is. And so what we want to do is we want to create a product that's very much a bedrock opportunity. So we're not talking about, hey, I have my high flyers, or I have my junior minors, or my bucket where I'm kind of speculating. This is very much for that money where your clients or yourself, you say, I want to put this in a place where I can sleep at night. I'm not worried that because of anything, any one thing, the stock market's going to move, and this is going to move too. And so when people really started finding out about that portion of it, and it kind of got out of the institutional space, a lot more people got into it. And so what you see now is this space, not just institutional investors, but you've got little guys coming out saying they have access to this opportunity. And really what it is you really only have access to this opportunity truly if you've got the right deal flow. If you cannot get deal flow, that's all that matters. And so we'll talk more about that here in a minute. But what I want to start off showing you is right here. This is the AAP index. And this is a company that, among other things, aggregates a lot of the life settlement statistics. So you can see it's being compared to the S&P 500, the hedge fund index, and some other benchmarks that a lot of these companies kind of match themselves to. So we know the S&P 500 has been in a bull market for a long time. From here, it's 2012 to 2018. But look, even though the S&P 500 did incredibly well, it was very volatile. And maybe if you were investing in this 2014, 2015, 16 area, maybe you had a little gastrointestinal issues because you're saying, oh, my accountant's going crazy, but I know I'm supposed to buy and hold, but the volatility is just not fun. Well, had you had part of your portfolio in life settlements, you would have been able to sleep. You would have known that the money is going to be there tomorrow. You would have said, hey, at least some of my stuff is not volatile. This is great. And look, over time, it actually beat the S&P 500 in this example. So that's really what we're coming to show you today. And that's why it is now so investable. So what we're going to do is really quickly talk about not just the fund, but kind of what's the difference between a life settlement today versus tomorrow versus what it used to be and what it is. There's really two ways to play the space. I could take 5 policies and I could take 50 investors, and they could all invest a different amount, but they're all going to be attached to those 5 policies. We call this the transactional space. And it is a fine way to play the space. In the state of California, people get very creative with this product and they do fine. They do okay. The overarching return tends to be about 7.2% because usually someone's making a large commission on that transaction, which again is not a bad thing. It just means that's how you have to shape it. But the problem is there's no liquidity in that situation for maybe 8 years, maybe 10 years, maybe 6 years. And so you've got this pretty good product. It truly is non-correlated, even with liquidity concerns, because you're stuck to those policies for a long time. But if some of those policies or the insured, they live longer than expected, well, you will have to have a premium call. Are those premium calls really big, and do people lose a lot of money because of premium calls? No, they don't. However, no one wants to call up their investor and say, hey, Joe, thanks for investing that $100,000. I'm going to need a check for $1,000 to keep your investment viable. Joe's going to pay it because he doesn't want to lose his $100,000, but at the same time, he's going to be a little annoyed with me, his wealth manager. And even if he just has to pay a small fraction, that's all he pays, and he still makes great money. So what we've done is we've gone, instead of to the transactional side, we've gone to the hedge fund side. So what's the difference? Well, first of all, investors are not attached to any one policy. In fact, the fund is what's called open-ended. So that means we're always raising money and we're always buying policies because we have that high quality kind of deal flow. In addition to that, if there is a policy that is underperforming in an open-ended portfolio, that doesn't really mean much. It doesn't mean we have to go out and say, oh, we're going to take a big loss on this policy, or we need investors to do something like write us a check, or we need to make a capital call. And that's really the beauty of it. But you also have beautiful liquidity. That's really the difference. You don't have to do a premium call, and there's liquidity after 12 months. So that means you're going to make a reasonable commitment, not a 5 or 7 year commitment, but a 12-month commitment. And you're going to say, I'm going to put this money here. Hopefully it does great. And if it doesn't, I know I can get out in the next 12 months because this fund is going to provide me liquidity. And what we do is we go out and we work with very large institutional hedge funds. One I'm going to show you here in a minute. It's an emerging manager. We like to work with emerging managers because they scale very quickly and they provide amazing returns for investors. And we become a part of their deal flow. And so they're the smartest person in the room. We're simply the ones with all the contacts and the deal flow. So we access that for investors, and that's what brings the return to investors. And we're going to talk about what that looks like here. And feel free, doesn't have to be a dissertation. I'm not on a soapbox right now. This is my real hype. So if anybody wants to jump in and ask a question, feel free to do that. Just unmute yourself. So we talked a lot about why we kind of invest in this space and why it is investable, but I'm going to put my RIA hat on here for a second, and I'm going to say, you're going to love this product, but if I don't tell you how to use it, you may have trouble saying, where does it fit in my business? So I'm going to tell you right up front, it really fits in 2 buckets. The bond replacement or bond alternative bucket. You can see here, high yield, low risk returns. We talked about the volatility. I showed you the graph. If you have investors that do a lot of bonds or would like to do a lot of bonds, or that's older, or they want that bedrock investment, this is perfect for that bucket because it's a shorter term commitment. It's not 5 to 7 years, it's 12 months, but they're going to get those target returns somewhere between 10 and 15% compounded with no income. But because there's no volatility, bonds tend to be less volatile than stocks. It's a very good replacement. So we call that kind of a bond alternative, if you will. So that's the bucket that's going to fit in quite well. And obviously we know bonds are not doing so hot right now. The general rate environment is very low, and the general amount you have to pay for a bond is quite high. And so we have something called duration risk. And so in that world, if the rates all of a sudden start to go up because of or in spite of the Fed, then a lot of our longer dated bond portfolios are going to take a hit. This is a great way to hedge out a lot of that risk. The other bucket that's really going to fit in as a wealth advisor, an RIA, is going to be that non-correlated bucket. And the reason that's significant is because there really has been a rise of this idea of non-correlation. So we want to have a 60-40 portfolio, let's say, and we expect the bonds, the gains in our bonds to protect the losses in our stocks and vice versa. Well, in 2020, when the stocks and bonds really started to get hit because of COVID, what happened? We saw a lot of these over-invested passive strategies with ETFs and investing in a very illiquid market that is bonds. We saw that get liquidated and kind of everybody trying to leave the exit at the same time. What did that do? That hit bonds. Bonds actually went down by 35%, just like the general equity markets did. So just when we really needed that kind of non-correlation, we didn't have it. And I think people are really starting to get keen on, hey, I want to invest and I want to be diversified in equities. But if I have all equities, I have that volatility risk. And that's the risk that your client says, Joe, get me out. I'm scared. I don't like what's happening. And investors tend to do that the worst time. So this is a way to give them that bucket full. So the non-correlation bucket. So non-correlation and bond-like returns is really what we're looking at here. So why would somebody want to work with us? Well, we like to work very specifically with 2 things: emerging managers, that's our value to the market, as well as vertically integrated managers. So there are managers out there who say, hey, I know some people, I could go out and buy some policies. But the problem is those policies, if you're buying onesies, twosies, they're going to hit through maybe 5 or 6 sets of hands, and everybody's going to take a little bit, and there's going to be a lot less left. So if we look at the market as a whole, all policies go for about 12% internal rate of return. It's a discounted cash flow model to how much you pay for it, whether the carrying costs, and how much you get paid once the insured passes away. And that's great. But we can do much, much better than that because we work with managers who are very close to the life settlement spigot, if you will. So as all these deals are spewing out, we're part of a very large buying group, and that's our value to the market. And so Investors that invest with us are investing with the larger buying group. They're getting a lower discounted rate. So instead of paying 12%, they're going to get 16 to 18%. And that's really how we book our profits. And because we work with emerging managers, those emerging managers are going to allow us to sustainably get those high rates of return that we're expecting. We're not working with the guys like Carlyle and some of these other multi-billion dollar firms because they already have the problem of scalability. They've got 5 billion of assets under management. We're working with managers who have less than 5 million under management. And now they can provide those 12 to 15, those 10 to 15% returns for the next 10 years and not have to bat an eye. And that's really where we're going to provide that value. One more value is going to be our minimums and such, because a lot of these companies, L'Oreal, for instance, their minimum is 350,000. Most investors who haven't heard of this space or don't have 50, 40 million to deploy, 350,000 is going to be a lot for them. And we want people to be able to come in, dip their toe and say, hey, this is a great fit. After 6 months, boom, maybe we can double that investment while they see that, yes, there's not a lot of volatility and they're doing well on their investment. What I was talking about with the vertical integration was that we are not working with investors who just can buy policies and they kind of farm everything out. We're working with these portfolio managers like Mondial, we'll get into in a minute, that are vertically integrated. What does that mean? That means they've actually done every part of the life settlement process, not just the buying and selling. And because of that, they're actually going to decrease the amount of money that the fund is going to have to pay in order to keep up the portfolio. And that's phenomenal, because if you've got a problem with your servicing, that's going to eventually affect your returns. And if you don't understand that portion of the asset control, then you're going to have all these unforeseen circumstances that you should have really been able to take care of. And so that's why we're looking for vertical integration. So that's kind of what we're talking about here on this slide. I know I've got a lot of words, so we're just really talking through it. These are private investments technically, right? None of this is traded on the public exchanges. So probably your first question is, okay, Eric, Jordan, how do you steal my money? What does that look like? Because there are so many people out there that say they can do things, but when it comes down to it, that's not the reason people lose money. It's because something just goes drastically wrong and the manager loses his head. Well, let me tell you, we have built this thing from the ground up to be very institutional. So I could be talking to somebody who's at a pension fund, a family office, or you could be talking to BlackRock. There's not going to be a significant difference in the way we run our business versus one of those companies. So when you put money with us, you're not writing a check to us specifically, you're writing a check to the fund. And those are corporate accounts that are held in dual control. In addition to that, we get the fund audited every year. In addition to that, we have an administrator that makes sure that we don't make those big mistakes. But even when all of those T's are crossed, if we wanted to go in and manipulate or do something we were not supposed to, it is actually impossible. And what does that mean? That means all of the assets, all of the money is held in a place where we don't have access to. So we actually have to go in, ask our third-party administrator. It's NAV Consulting. They have $100 billion of assets under management, under administration. There's no way they're going to let us do something we're not supposed to. So when you're kind of doing your due diligence, your initial checkpoints of, is this something that even makes sense? Know that this is all of the money, all of the assets are in a place that is designated for assets in institutional form. So we're not saying, hey, we're a bunch of guys in a garage and we have this really great way to trade stocks, just put it in our account and we'll figure it out later. No, we've built this thing from the bottom up to be very institutional. And that's why we talk about the policy, and this is, I'm referring to my deck now, the policy valuation by Lewis and Ellis. We're not the ones telling you this is how much this policy is worth and what we should pay for it. We're getting it done by a third-party valuation company, or Mondial is getting it done by a third-party valuation company, and we're just there along for the ride. So we talked about the vertical integration, closing the deal, policy servicing, all really falling under the premise that we're working with competent managers that know the space incredibly well. In fact, the portfolio manager at the initial manager that we have identified for our fund, he's been doing this for more than 10 years. And it's not a guy off the street that got trained. This is a person who over the last 10 years has been living and breathing the sector. So when he gets up in the morning, he doesn't say, what am I having for breakfast? He says, I wonder what deals I got sent today and how I can capitalize on that for my investors. And that's what's really important to us. So this is our operation. This is how we work. You can see there's a lot of great names on here. If you've been in finance a while, it's very likely you've heard of Spicer Jeffries, top 10 auditing firm in the United States. Nav, I was on the phone actually with another hedge fund manager, and we were just kind of chatting back and forth about administrators we were using. He's like, "Oh, what's yours?" We said Nav, and he goes, "Oh, I love Nav. Yeah, I use Nav too." So this is all very important. So really what we're looking here is kind of how the fund works. So I'm going to skip over this one actually and just go straight to here. What I've done is I've got a lower minimum investment value. We are an institutional investment fund, but here's the thing. We know a lot of investors are going to want to get in for probably something less than what our minimum is. Our minimum right now is $100,000 to get in and $25,000 for a reinvestment. But to really solidify that relationship with our registered investment advisors, we allow them to come in a little bit lower. Eric, do you want to touch on that a little bit?
Well, you just did, so I don't need to talk about it.
Wonderful. So the whole point behind that is investment advisors, they always want to create a relationship. I know when I'm talking, I can tell immediately if I'm talking to an RIA or a broker, because the broker is going to want to go, all right, well, that's great. So how much am I making? Where I talk to my investment advisors and they go, great. Well, how do I know you're not Bernard Madoff? And we talked about that. But right away, I'm thinking, okay, so this guy really cares about his clients. So he wants to create a relationship. So in order to create the relationship, we are willing to take in some lower amounts, and really with the idea that eventually those same investors are going to come in with a phone call or an email and say, hey, this went exactly how we expected or what you told us, Joe. We like it. Why don't we do another investment? And boom, we can get those doubles and those triples, and then we could really start to build this thing out. Everything else on here, though, is what we talked about and what you'd expect. You can see our partners, our investment period being 1 year, management fee 1%, performance fee 10%, and that all stays the same.
And this would be a really good spot for me to comment. So with Joe and the group, we're offering 40% fee split at that point, and then beyond that is whatever agreement you have with Joe. So hopefully that makes sense. But we can come back to that at the end if you guys have more questions.
Yeah, and actually this is a great time to pause for questions. Thank you, Eric. What are you guys thinking so far? What have I touched on that maybe you'd like me to go deeper with?
I'd like to hear about the cash flow. Do you guys pay out anything monthly, annually? Is it just when client wants money? Could you go walk through that, but how that works?
Yeah, so this is an accumulation strategy. So it'd be very similar to, working with somebody like a Warren Buffett who never wants to sell. I mean, we obviously will sell, and a lot of our policies eventually start maturing, about 20% a year, but we're looking to buy and hold these policies until they pay out completely. So that means we're not really making the phone call and saying, hey, there's some income, would you like it? We're actually taking that money and redeploying it. It's in a true fund fashion. Now, let's say in maybe 3 to 5 years, we have enough of the portfolio that's turning over to where it's just kind of doing its own thing. At that point, we can make a call. A lot of what these funds do in their 6th, 7th year is they call their investors and say, hey, do you want a 5% return of capital or return of performance fees or whatever? Or would you like to just kind of continue on with the fund? And what most people do is they continue on. But no, there is no income associated with this investment. It was accumulation only.
Right. But then also, can you show performance on Mondial so that we can see what that looks like monthly?
Love to. Here we go.
And then after a year, just so it's clear, Joe, that it is possible after a year that there could be a request at a 90-day request for funds, so that could say how much the client wanted. So there is a way to start drawing on the money. So just so that that's clear, because I know there are a bit of questions all around the board here.
Yeah, and that's a great point, Eric. Thank you for saying that. If people want some of their money back, they put in 100,000. We do great that year. We turn 100 to 112. They can call us and say, hey, let me get that 12. I'm going to go put it as a down payment on my trailer, and I'm going to let the rest run. We have people that do that as well.
And one other thing I'd like to mention, because we're in the hedge fund space, what Mondial does to get the performance numbers every month, besides holding some policies, is we're able to trade policies that we've had them underwritten for a higher value. So that's another angle that we have of making performance besides waiting for maturities on policies. So that makes us a bit more nimble to deliver, what the clients are expecting. And we would expect to be between 10 and 15% performance per year.
And that's net of fees. That's after fees.
Can I ask a question?
Hi,
This
Uni.
is me. Hi, Jordan. I don't know if you still remember me. I was there at the meeting.
Oh, I remember.
In your office. So I have the same question. I really like this product, and since you already have some kind of an audited paper to show to my clients and why papers are good and everything else, I really like the fact that it's really not correlated with the market, and it's really hard to produce a minus performance annually. So this is a really good hedge fund portfolio item, and I really like it. I do have some clients that I can actually refer, but only dilemma that I've been like trying to figure it out is, my license is hung at a different company. So how am I gonna get paid from Joe, from Eric, or I don't know how it's gonna be like.
Yeah.
Well, we would pay Joe and then you would receive your split through Joe is how it worked.
Okay, so that's okay, but then how am I gonna, do I have the right to receive like monthly performance, statement for my clients, or how would I keep track of it?
Well,
Yes.
they would have a login, but Jordan, continue.
Yeah, so I can show you the paperwork if you'd like to see it on the webinar. But basically, when your client goes to fill out the paperwork, they can ask that a duplicate copy is sent to an address or to an email or something. We have a lot of clients. For instance, I have some clients that are in, they're Vietnamese and they don't really speak English at all. So I give them a paper copy, and they also, their agent also has a copy of their statement. So when they have questions, they just go to their person and say, hey, can you read this to me? So yes, you can get a copy.
And then
Okay.
just so you know, there is transparency for the clients. They actually have a login and ID at NAV Consulting, so they can look at that whenever they want. And actually that's been helping us get additional funds because the clients start seeing what's happening and they want to add to it.
Okay. All right, then I'll try to talk to some clients and maybe try to sell this. I really like it.
Yes, and if you need supporting, we've got a very small due diligence package here. It talks about NAV Consulting. You can go to their website. It talks about Spicer Jeffries here too. You can go to their website, and that really gives clients the confidence that, hey, this is not one of those things. This is something that is up there with any other institutional investable space.
So what is the size right now of the fund?
So Mondial,
yeah.
Sick. Mondial Consulting is just hovering under 5 million right now. So they're a little bit above 4.5 million. And what's beautiful about that, again, is they can be extremely picky when they go out and buy policies. They can go and say, hey, this is a list of 30 policies I got this week. I'm only going to pick these 4 or these 5 because these are 100% the best ones. These funds that have, say, 5 billion under management, they're going to go, we have to buy at least 50 policies this month. So even if it's not that great, let's go ahead and buy it anyway. And it takes, it might take 10 years to get to that point. By that time, investors will have doubled and tripled their money before they ever reach that point. So this is a chance to really get in with a manager that has the long-term sustainability to hit those rates of return. And that's why that lower assets under management is very advantageous.
I asked this question before too at my first meeting with Eric in your office. That the only thing that I have a little concern about this type of investment is that exactly the point that you just crossed right now, that okay, so what if you know, your company being so successful, gathering so much asset from you know, many investors, and the fund size grows maybe like 50 million, 100 million, but then what if you know, you don't really get to utilize investing all the money because you cannot find the right contract to buy?
That's actually a really reasonable question, Uni. So I have another hedge fund manager that we work with. His name's Chris. He's in like the 400 to 450 million dollar range, and he has no problem creating returns for his investors. He's in his 7th year, and his average over the 7.5 years was 15.5%, and that's non-compounded, or excuse me, that is compounded. So he's killing it for his investors, even at $400 million. Really, and like I said, unless you're at 2, 3, 4 billion, it's really hard to have that problem. And I'll tell you what, I'll even back that up one more time. There's an association called LISA. It's a Life Insurance Settlement Association. And I was at their conference this year, and I wasn't physically there, by the way. It was just a Zoom conference, but it was over a few days. And everybody was just so happy because the market for life settlements is expected to grow and not shrink over the next foreseeable future, the next few years. And as we have people that have income issues and they retire, or they're going on Social Security, or they're on fixed budgets, or even this whole student debt situation, this 1.4 trillion that we have that's growing every day, and seniors having these Parent Plus loans they can't pay anymore, they need the income, they need to sell their life insurance policies, and this market is there to accommodate them. So over the foreseeable future, Uni, we expect it to be great.
And then I saw a little trend. I know it's only been almost a year now since this fund has been incepted, but in the first 6 months, the monthly performance was kind of like higher than the later 6 months in 2021. So what is the reason, do you think?
Uni, you're asking all the right questions. I really have to tell you, I almost feel like you're a mole. Are you asking these questions on purpose? So here's what happened. No, it's perfect, because
I'm asking because I'm interested. You know, I need to get to know all the answers right before I.
Yeah.
Clients,
yes,
they're gonna
100%.
ask the same question, so I need to know how to answer. Right.
Right. So what you're seeing is actually what I've been talking about in effect. So look at June, it's 2.76, July 2.78, and we close the year out at 14.7. Well, that's what happens when your fund is not multi-billion dollars. You can absolutely murder it. I mean, that was 14% that year, but we just as easily could have done 50%. The thing is we don't want to, because we want investors to see sustainability, not 30% one year and 3% the next year. But he made the first check into his fund at $100,000. And then another large capital raiser in the space, his name's Chris Griffin. He's from Griffin Asset Management. It's hedgeact.com. There's some investors that have raised a few $100 million, and they put a lot into Mondial alongside us. But the reason that's significant is because he also wrote a check. So his first month was only $200,000. So he didn't have to spend a lot of money to create 2.76% return. And then the next month he doubled, and the next month he doubled, and the next month he doubled. So he was at $1 million very quickly. But even with a small amount of money, so really anything under 100 million, he has to be careful on how he buys policies, even though there's a lot of opportunity, because if he buys too many policies, he's going to create returns that are unusually high. So that's why it's gone up so quickly, is because it has to go up quickly, because he has to buy something, and it's going to greatly affect the amount of return he gets for that month.
Okay, so I know it's a kind of stupid question, but then I don't want to sound like I'm over exaggerating the performance to my client if I explain this fund. What is sort of like a reasonable annual return you think it's going to be going forward?
What we like to say is we have a target return of 10 to 15%, and we're confident that we will make that.
Okay. I was just a little concerned because the numbers that I'm saying, if it goes down, trail down little by little, and then it's like really small down the line. So so it's okay to say like 10 to 15% annually. You think?
Well, what I would say when I talk to investors is I always say, that's what our target is, and we're confident we'll make it, because it's a big difference than saying, hey, you're going to make 15% every year, because that doesn't leave you a lot of flexibility for the fund to move.
Right.
So and know your investor. If you're talking to an investor who's extremely conservative, and if you say the wrong return, he might run for the hills because he said, oh, 12%, that's impossible. Tell them, you're going to do well in this fund, sir. 8 to 10 or 11%. If you think that's the kind of investor that's what they need to hear, tell them that. And then when we beat it, he'll still be very happy.
No, I mean, that's really great. Even with a 5% difference, 10 to 15%, I mean, even if they do annual 10%, that's really, really great, Jordan. I mean, and then they can reinvest the return. If they don't have an immediate, cash liquidity problem, they can just, use this as a long-term investment. So I really like it.
Yeah, and you could almost call it uni a third bucket. The third bucket being uni, I'm scared. The market's at an all-time high. It's just unsustainable. I want to take my money out of the market. Where else can I put it other than the stock and bond or publicly traded market? You say, hey, let's take out a big chunk of your money. Let's put some of it. We don't want all of anybody's money, but let's take some of it. Let's put it into this. We're going to be there for as long as it takes for the market to take a serious correction. When that happens, let's request some of that money back or all of our returns, and then let's just jump back in the market. I think that's going to resonate with a lot of people right now, especially older people that have been through it. I mean, we're not talking older like me, where I've been through one, maybe two market crashes, but those folks that have more gray hair than me that are going, well, I remember the dot-com bubble, and that was awful, and I want to make sure I never experience that again. Let them know. It's a good place.
So one last question. So since your fund is, it's good that it's new, but at the same time, since we don't really have any sample, like long-term performance to show to our clients, that to give them some kind of peace of mind, right? Do you have any sample? It doesn't have to be your company's, but then some other life settlement company performance, to show some kind of a longer than a year, maybe like 5-year, 10-year history.
I'm way ahead of you. Give me 1 second. I actually get this question a lot, so I keep on hand a lot of other funds investment information. So let's start off with someone I'm extremely familiar with, L'Oreal. Let's see. So L'Oreal had about 14 different funds because they had a lot of feeders that were inside and outside the United States. So I'm just looking for the one that's most recent, and the most recent one is not showing all of their performance. So I may need to come back to that one. So let's just pull up another one. So this is also one I'm pretty familiar with. This is Carlyle. So Carlyle has been around forever. So this is just one of their investment packages that talks about what their returns have been like over the long period. So, I mean, look, 15, 9, 22, 31, 28. And it really was, in that 17, 18, 19 area where they did great. And, they started getting a little too big for their britches. But that didn't happen for a very, very long time. So the investors that have been in here for a while, they've already doubled, tripled, and quadrupled their money over that investment period. And that's the kind of return. We are not looking to make these kind of ridiculous returns, because if you start doing 30%, you're going to disappoint investors eventually. And so we really don't want to do that. But we can do these 15% years and these 14% years, and maybe a 12% year here and there, because we want to last for the next 15, 20 years. But this just gives you an idea of what it's like to have a company who started in 2009 and now is still, even in 2019, absolutely murdered it for their investors.
Okay. So yeah, maybe because of their fund size is getting bigger. I see if you look at the annualized return, it has some kind of trend right there. So Yeah, okay, yeah, that's fine. I mean, they're not losing money, obviously, and it's really nothing to do with the market, so I like it.
And that's really what I think everybody on this call needs to realize. The really bad life settlement managers are still making money. Even the ones that are too big for their britches, even the ones that don't have the deal flow that we have, they're still doing okay. There's nobody who's consistently losing money in the space. In fact, probably the biggest is Vita, which I have right here. They've been around, I think, one of the longest, if not the longest, and they're not doing so hot like they used to. They've actually run into some other problems that are outside of just what we're seeing here today. But even them, they're doing okay. They're doing fine. Now in 2020, the market and life settlements got a little sticky, and a lot of funds had problems because everybody wanted to just get out of literally everything. I mean, stocks, bonds, mutual funds, life settlements, timber, you name the alternative investment, people were just trying to liquidate whatever they could. And so in that situation, they're not raising capital as much, and they're not looking to go out and purchase new policies, which means they're not going to have if you're not purchasing policies, then you're not going to have returns. And if you don't have returns, then you're going to have a few months in that situation where you're going to sit out. But
Okay.
you can see us, we were also alive in that time, and we had no problem taking care of our investors.
All right. So I'm sorry, just one last question. So what kind of investor protected insurances are provided with this fund from your company?
Okay, let's talk about that. Number one, NAV Consulting. Why are they investor protection assurance? Because we cannot access our accounts at CIBC Bank. That means if Eric wants to go buy a new boat and he's got 5 million sitting in his corporate account, there's absolutely no way he can access that money. He can call up CIBC Bank and yell at the lady on the other end, and she's just going to say, "I'm sorry, but I don't even know who you are." We can call NAV Consulting and say, "Hey, NAV, set up a wire so I can buy a boat to this place." And they're going to go, "Okay, well, let me check." And they're going to look at our private placement, and they're going to say, "Eric, no, you can't buy a boat. You can only invest in life settlement funds." And that's where it's going to stop. So it's literally impossible for us to steal from our own fund.
Okay.
Even farther than that, we have Spicer Jeffries. Why is that an investor protected assurance? Well, they're the ones that are going to be sitting at our audited report. Uni, have you ever seen an audited report on a life settlement hedge fund?
Well, I got your recent one that was done. Was it
Right.
March? Was it
yes,
March or
yes,
April?
it gets done around March, April.
Yeah,
And I say that because you know that we're doing what we're supposed to, not because Eric told you so, but because Spicer Jeffries, top 10 auditing firm in the United States, told you so.
Right. So, like I said, I'm not asking these questions to interrogate her, like to be a mole. I'm
but he's just
asking
trying
because
to
I'm very,
answer.
very interested in selling this product, and I've been thinking about how to go about it, right? Because because the situation that I am at right now with another company. So, let's say I bring in $100,000, just as an example. How much am I gonna make from Joe? Joe, tell me.
Well,
I don't
Uni,
have a license with you, so how are we gonna handle the payment to me?
Well, you have to be careful about that with your company. I have no problem paying you, but your company might, because you have to list your outside business interests, and you really should get permission from them before doing it.
Yeah, you're talking about OBA.
Exactly.
So, it has to be done between you and me. Then I guess I need to craft something that we don't have to report.
So let's not say that online.
Okay. Yeah, we're gonna allow you guys
about.
We're gonna allow you guys to defer to Joe and that whole situation.
We'll figure it out
if that's okay. But Uni, I want to make it very clear. I love your questions because you're helping everybody that's on the line right now. I'm sure there's somebody here that's going, I'm not totally sure what I should ask. And when they hear you ask the question and then I give the answer, that helps everybody. So please continue.
No, I mean, I got all the answers, majority answered at the meeting, and today's was just like, some of the confirmation questions. So I'm very happy. And I think this is really a good opportunity for everybody. If everybody's have their typical like stock investors. This is really something that really they need to consider to put in their portfolio. Not maybe 50% of the money. I'm not saying, but maybe 10%, 15%. Just as part of the diversification, and this is a really good strategy.
Thank
We
you
appreciate
for the commercial.
Huh?
Thank
Yeah.
you for the
She's not a mole, guys.
It's
She doesn't work
true.
for us, in case you're wondering.
Yeah, I'm not working for Jordan or Eric. I just like them, but I don't work for them. Yeah,
Okay,
so I'll
Do we
try.
have?
Yeah.
let me ask the harder questions. A client of mine always says everything works until it doesn't.
Yep.
And as we saw that other company, last year they were down 5%. What else can go wrong other than everybody heading for the doors?
Well, execution risk. That's number one. Let's say Luke just says, I want to run the fund into the ground. He could go out and buy and pay way too much for a bunch of policies, and that will absolutely 100% decrease returns. Does that mean we'll lose money? Not necessarily, but maybe. And if we did, it'd be very slowly, it'd be over time. Does that mean you'd wake up one day and your account would be down 30%? Absolutely not, because we keep a diversified portfolio. That's kind of what's great about it. For the whole thing to absolutely blow up, so I haven't actually found a good way for the whole fund to blow up. But I suppose if we had the cure for every single disease one day and people just literally were not dying, kind of like what happened to viatical settlements back in the 80s with the AIDS epidemic, that would be a problem. But luckily, we're buying policies on people that have multiple comorbidities. They're in different places in the United States, and they're the best policies out there. Another way that we could potentially have an issue, other than a run on the bank, is so back in 2000, I don't have the chart with me, but back in 2007, 2008, I forget exactly the year, there was a change to the VT tables. And the VT tables are the actuarial tables that are pretty much used by every life expectancy and insurance company out there, at least in the United States. And what they do is they go backwards and they say, hey, this is all the diseases and what it caused in our studies. And we have decided that it's not 3, but now it's 2. And so they went back in all the tables and just readjusted everything. And that happens every so often. It's not completely unheard of. And that's kind of what I said in the beginning of the webinar, where that's the worst thing to ever happen. Some funds were down 4, 5, or 6% for the month. They still ended up the year quite nicely, but a lot of funds were down significantly, considering you're only making maybe 1.5%, sometimes less than 1% in any given month. So that's a lot. But funds recovered. Most did positive for the year, but that's another way that you could have a shock to the system that says this is not what you expected.
Right. What about just increased competition? A lot of other people saying, hey, this is a great space to be in, and you just don't have enough policies you can buy.
Yeah, so we've talked about that, actually. We think the industry is going to do incredibly well over the next 10 years. I think after 10 years, you're probably going to have enough capital chasing it where the IRRs are just going to go down. They're going to be like, instead of 12s, they're going to be 8s. And instead of us paying 16 to 18, we're going to have to pay 12. So we'll still have our differentiator and creating about the same amount of value. But the problem will be is the overall return to robustness of the space will be competed out. And that won't come from just competition. A lot of experts in the space are saying that will come from just more capital chasing the space. And because there's more capital chasing it, the processes get better. This is still a very much a good old boys club. Just like stocks used to be. When stocks were first invented and you were trading them literally on Wall Street, physical paper between people. So good old boys clubs. So you knew exactly who to buy from, who not to buy from, so on and so forth. But as soon as everything got systematized and the right amount of money was chasing it, now it's extremely competitive and it's hard to make money. It's still a good old boys club in the life settlement space. So over the next 5 to 10 years, we think it'll be okay. But at some point, you're going to have trillions of dollars coming into the space, which you do not have right now. And that's going to bring down returns.
Yeah, that makes sense.
But if you are involved in a portfolio like ours or like Mondial, and you realize that now the IRRs have gone down by bond trading gentlemen, what does that mean to the value of your portfolio?
Well, hopefully that means it went up.
Right. So if I have a policy that I bought for 16% IRR and the market views it at 12% IRR, and I hold it for the next 5 years, and now it's a 8% IRR, I did pretty well. So there's some upside in that scenario also.
What else can go wrong?
What else can go wrong? Well, let's pick it apart a little bit. Part of the reason we do the audit isn't just because we want to be fair, equitable, and transparent. We do it because it's just a good idea for business. So there are places where the bank, our administrator, they can make mistakes. They do make mistakes from time to time. They miscalculate fees. They miscalculate performance. They miscalculate. Maybe they even misread the PPM. And when that happens, we find out about it. We come back, and the audit will see it, and maybe we have to claw back money. Maybe someone invested 100,000 and we made 15%, so we gave them back 115,000, and maybe we have to call that investor and say, "Oh, we made a mistake. We need 2,000 back." We're not legally allowed to call them, but in order to not have to deal with that situation, we make sure that everybody gets all of their money back minus 10%, and that stays in the fund until we do the full audit to make sure there are no mistakes, and at which point to get the rest of the money back. The reason that's important is because, yes, we do have the ability to say, hey, it's just $25,000 investment. Let's just give him all of his money back. It's not a big deal. We have that discretion. But at the same time, we like to hold the funds back for until the audit is completely done, to make sure that that nobody made a mistake in the process. So there are little things like that. It kind of depends on the question. If you're talking about catastrophic, the only real catastrophic is a bank run. But if we do have a bank run, there's a couple things we can do. Remember, the bank run is only significant in the sense that everybody wants their money out at the same time. It doesn't necessarily mean people lose money in that situation. So unlike a bank where they're required to give your money back and they can be taken over by the FDIC, we have the ability to throw up the gates if we have to. So if we had COVID 5.0 and literally people are dying in the streets and people say, we want to liquidate anything and everything we can say, okay, reasonable. We are going to judiciously manage this situation, and we are going to get people out as we can. And otherwise, people will have to start taking markdowns. Now, even in that situation, we have some flexibility, so we can give people refunds, redemptions in kind. So that means if someone has $10 million with us, it's a family office, maybe instead of giving them $10 million, we give them 30 policies. And then they can take those policies and they can try to sell them themselves or manage them or what have you, or sell them off one by one. Or they can even take those in kind and put them to other hedge funds that may not be having a liquidity issue. So there's lots of flexibility there. And even in the worst case scenario, which is, oh gosh, we can't raise capital and everybody wants their money back, we still have the ability to muddle through the situation. Will it be fun in the short term? Absolutely not. Will we communicate it as soon as we find out? Of course we will, because that's what's going to allow us to stay in business. And then once that moment passes, which people thought that was going to happen in COVID, things go back to normal. And even in 2007, 2008, the market did not see a total liquidity crisis in life settlements. It still chugged along quite nicely.
Yeah, all righty. All right. Well, this has been great. Do you have anybody else have any other questions or any final comments you guys want to make, Eric and Jordan?
What is your company projection for this year and going forward next year and on?
Let's see. I don't know if Eric has some comments about that, but of course we want to grow as quickly as we can. It would be nice to hit. I would like to see the mothership Mondial hit like a little sub 10 million. We have a lot of institutional investors that are looking at us and looking at them, and so we've been coordinating a lot of meetings as of late. And if I hit 10 million, if we hit 10 million as a team, that would be great. But as far as projections, we're not super big on projections, because for us to do well, we don't have to knock it out of the park. We just have to kind of chug along. And and honestly, if we just do a few 100,000 a month, we'll be able to maintain our level of return and performance over a very long period of time, which we believe is the most important part.
Sounds good. Thank you. That was it.
Uni, I appreciate the
Thank
question.
you, guys.
Seriously, thank you.
Yeah, it was perfect.
You too, Joe.